Good evening, reader. Welcome back to the Oak Bloke Substack and YouTube channel. We're going to talk about Serica, and this is one of my Oak Bloke 25 for 25 ideas. This is all just ideas. It's not investment advice. You make your own investment decisions. If you like watching these videos, if you like reading the 473 articles that are now on my Substack, I would strongly encourage you to support Emmaus. So many of you have. Thank you so much. Just kind of take you to at the top of my Substack. So my Substack being the Oak Bloke, all one word. .substack.com. This link here, help Emmaus, is funnily enough how you can help me help Emmaus. So if you like what you read, you can see here 101, just like the Dalmatians have helped. Thank you so much to all of the people that have. Some have even helped twice. How about that? Humans, robos, everybody is just helping. So please consider helping as well. If you have, then fair play to you. Thank you so much. I can't ask for more, but that amount of money is a real big difference to the Emmaus charity. I won't talk too much about it because you can go and look it up for yourselves, and you're here to listen to me about Serica. So let's get to the topic in hand. So look, from time to time, I say to readers, like, well, people will say to me actually, would you look at so and so? And inevitably, there's more people asking than I have time to go and do the. And I don't like to kind of do a how do they put it, a kind of desktop or a very brief review of something. I like to kind of get into the weeds and kind of disassemble it and take it apart and really understand it, because what's the point? I mean, otherwise I'd just be probably telling you what other people can tell you, which is, sort of, it's got this many price earnings and this much price book, and the brokers say this and the brokers say that. I mean, it's just, I don't want to just regurgitate what's out there, because what's the point? You can go and look that stuff up for yourselves. I mean, I'm not always right, as people love to point out. Yes, the Oak Bloke got it wrong again. But look, I mean, I actually went through and worked out how many of my articles were right or wrong, and it was about 2/3 that were right, which is not a bad record. I think that's, it's above 50%. So, and actually, if you timed it, it's not up to me to tell you when to buy and when to sell. It's up to you to decide those things. But if you timed it perfectly, you would have made 46%. And I think I had quite a number of double baggers and some triple baggers. So, there's gold in them there hills. You've got to figure out which one to pick, and when to pick it, and when to unpick it. So there we go. As I say, this is not advice. It's just you tuning into my video for entertainment. So look, somebody said, love you to look at Serica. And so I can't remember whether this was one where I then went, people vote for this, readers vote for this, and they did. Might have been, I can't remember. But no, I think it was just that some various people had said, oh, like you talk about DEC, diversified energy, a lot. You should, what about Serica? That's quite similar. So, it intrigued me, so I did. And I hope you like my, reminds me of that film Battleship. But this was kind of the idea that you've got to sort of have a bit of a tin hat or kind of a suit of armor to invest in the North Sea. Everyone's leaving the North Sea pretty much. So this company, Serica, are the ones that aren't, so it's great strategy, actually. You think about it, when Serica are announcing things like, let me just flash this up on screen. When Serica are flashing up and telling us that they've dug not dug, they've drilled. Maybe they dug, who knows? Probably that they drilled. Let's say that they drilled, a well in the North Sea, and you know, the average person, if you ask them, well, is the North Sea full of oil, full of gas? They go, oh no, it's all exhausted, it's all gone. You know, it's a mature field. Forget about it. Well, interesting that you should say that, because if you did forget about it, well, you know, 9,000 barrels a day drops down, because inevitably when you drill that you have the initial splurge, and then it steadies off, and you get a kind of rapid reduction, and then a sort of steady decline after that. So steady rate of over 6,000 barrels a day from one well, like that is pretty impressive. And then, we've got then news of a similarly positive. So can we infer into that that's another 6,000 a day? Similarly positive. Well, again, those words kind of sound to me like it's around 6,000 a day. Anyway, let's go back to this. So yeah, suit of armor. It's hated. The share was really, I think let's go and look at this graph here. Uh, so, right, ready for the steady decline chart. So yeah, if we say let's do it over 10 years, shall we? So there we go. If you bought it at the top of the market, I shouldn't laugh, because there's probably somebody that's watching this that has, and is harumphing madly because they've lost 2/3 of their money. But look, if you bought it back at the peak, £4.20, £4.30, and today it's £1.50. So yeah, it's dropped by 2/3. So quite a and I think I tipped the idea, or suggested the idea, around sort of 128. I think it was something like that, 129. So year to date, it's ahead, which is great. Lovely. Dropped a bit today, actually, 3.8. So nice entry point, perhaps. Again, that's for you to decide. But yeah, so the background to this was that. And I'll just show, I'll cut to the chase a little bit. That when I sort of started looking at some of the numbers, like, oh, price earnings is 2.8 now. Um, yeah, is that accurate? So I went away and did the maths, and I was like, well, no, actually, it's price earnings of 5.06. So yeah, anyway, that. But the thing that struck me was that I kind of looked at the market price, and I looked at the market price over those 10 years, and as I say, it was kind of this price, kind of back here, £1.20, £1.30, back in what, 2019, back in 2018, kind of that same price. And I went and looked at what the production was back there, and I was like, oh my goodness. So, like, essentially, the revenue back in 2018 was 1/20th of today. Profits were 1/6 of today. So you're getting 6 times the profits, for the same money, essentially. So it's 6 times cheaper, essentially. So that's kind of the first thing that I thought, wow. Um, that wasn't the only thing. Obviously, the next thing I kind of, and again, this is the common misconception. Oh, the chancellor and the energy secretary are just destroying the North Sea, taxing it to smithereens, and there's an element of truth to that. A 78% tax is the highest in the world, I think. I'm right in saying. Uh, and that's gone up. So that has actually gone up in last November. So just over 2 months ago, it went from 75 to 78. So real smash and grab. Now, to be fair, the Conservatives introduced that tax, and Labour just said, "Oh, we're not going to remove it." But it did come in under Labour's. Anyway, that's the history rather than the politics. So what struck me then was the cash and the cash flow. But also that when I sort of looked at the numbers, I was like, well, hang on a minute, 78% tax or 75% tax. I was like, but they're not paying 75% tax. So, and then I looked at that a bit more. Oh, okay. So they've got 1 billion of tax losses, and they've just done an acquisition where they're going to acquire more tax losses in relation to Finn Bewley, I believe. So, that and you've got to think, like, how many North Sea operators are there out there looking to exit the North Sea that have got tax losses that can be also bought up and utilised. So I'd venture to say there's going to be some out there, and I can kind of, again, that's another possibility. But also skills and expertise. I mean, again, like, one of the things about the North Sea is that once it's gone, it's gone. And the expertise in Aberdeen is a national treasure, and it's a national crime, in my opinion, that we are allowing that national treasure to basically just dwindle and die. Great shame. Now, of course, there is some repurposing of those skills into wind farms and other things, which is great. We need energy to compete in the world, and we have expensive energy, so we need cheaper energy. I don't disagree with any of that, and have crossed swords with a few people in the chatosphere and Twitter and places where I um, uh, you know I am I am supportive of renewable energy, and the evidence that I've seen is that it plays a role and that it actually is beneficial and positive. But we also need oil and gas, no two ways about it. I mean, even if we don't use it to burn and to use it for petroleum and diesel, we need it for lubrication, we need it for chemicals, we need it for plastics, we need it for a myriad of things. I mean, it's entirely naive and stupid to just say just stop oil. And in fact, in this article, I kind of talk about, or maybe it was this article or the later one, where I sort of talk, half jokingly about, well, if you really wanted to just stop oil, then unleash the equivalent of the sparrows from Game of Thrones, and turn your peaceful protesters into violent protesters that sort of stop oil in the tracks. Don't go after the producers, go after the consumers. If and I am joking, but tax the consumer, like we had a tax freeze. Like, if you actually wanted to cut oil out of people's spending, then just tax it until they stop buying it. It's as simple as that. Anyway, I've no interest in being political and talking about politics with anyone. I really couldn't care less. But as an investor, I think and I know that many people will agree with me that the current approach to our national resources is the wrong one, because we're only buying oil and petroleum products internationally if we don't produce them domestically. So, going after and taxing our domestic production into oblivion just creates risk for our country, because then we're reliant on overseas resources, and yeah, anyway, it is what it is. So anyway, back to this, and the reason I kind of looked at this and said, well, this has got to be in my 25 for 25 ideas, was this graph here. So this was a graph from last August, I think, September. Yeah, in fact, it says it here. It was in their interim 10th of September. So the next 3 years of cash flow. So the dot 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 is was the market price, the market cap. So just over 500 million, and today it is just over 566 million. So pretty much that chart is still relevant to today. But this essentially was cash flow for the net, for 25, 26, 27, for 3 years. 3 years cash flow minus the tax. So that's your cash flow after tax. That's your committed that's your committed investments there in there, those are your financing costs. So that's what's left in the pot. So essentially, this company is going to generate its own market cap in 3 years. So it's doing a, just in rough cash terms, 33% return, return on market cap, PE of 3, which, and a lot of that is actually coming back to shareholders um, as a dividend and as buybacks. The shareholder returns are spectacular. So I must admit, when I sort of looked at it all, I said, well, I'm going to lean into this. So this is one of my two 6 times loaded ideas. What that means is that I've got an imaginary 25 ideas, £35,000. Two of the ideas have got 6,000 imaginary monopoly money. The others have all got 1,000. So in other words, I'm kind of seeing Serica from the point of view of dividends, but also just in terms of its valuation metrics as being one of my cornerstone ideas for 2025. And as I say, I mean, obviously down a few percent today, but overall up for the year, and I think can go a lot further. So certainly when you look at news like, we've just drilled a 6,000 barrel a day. We've just boosted production by 6,000 barrels a day, or we've just done another well and it's similar. I mean, like, how is the how is how is the market reacting to that news in that way by dropping 3 or 4%? It's just mental. But look, we can make fun of the market or bemoan the market. It is what it is. I think what investors perhaps need to consider is, long term, where's this going to go, and can it make plenty of money in terms of dividends and returns whilst I'm waiting for the markets to smell the coffee or get bought out or something. Because um, yeah, anyway, back to this. So where are we? 17 minutes in. So I guess the things that I would talk about quickly and just point out is that 2024 was quite a tough, rough year. I talk here about bad luck comes in fours. So there was outages, there was a compressor that failed and then failed again, and there was some shutdowns, there was some seals connected to the compressors. So the whole year was pretty appalling. Well, I say pretty appalling. It was less than it could have been. But the good thing, I think, the thing that I like about the performance, and I've put the numbers into here. So this is in my article. But what we can see is today. Was it today? No, not today. 2 days ago. Sorry, the days fly by, and I say, oh yes, today, and I mean 2 days ago. Anyway, these were the numbers reported. So we don't have a full year-end result. We don't get that until April. In fact, it's kind of come out as an April Fool's by the looks of things, which, yeah. Anyway, bit of an unfortunate date to be releasing your full year results, but hopefully the joke will be on the people that don't buy it. Hey. So look, yeah, pretty much all of these numbers were just in the article, apart from this one, the adjusted EBITDA, which I've worked out as being the I mean, we get told the OPEX was 330 million, so we kind of get told the EBITDA, the adjusted EBITDA, kind of indirectly. So I've taken the OPEX, I've minused out the OPEX, which is that number minus that number, and then sort of arrived at 117. So I don't definitively know that is the sort of cast iron number. So that one you can sort of take perhaps with your however large pinch of salt that you want to, but it kind of is in keeping with what the result kind of looks like. Obviously, we've seen some deterioration to the cash position, but you know, they've been putting a lot of so the capex, um, as you can see there, I mean, that is a lot higher than in the past. So in the whole of 2022, 98, and then what was it, 70, 79 here. So the capex has really been boosted. So that's kind of why we're seeing a negative net cash, obviously combined with a weaker production. We can see now, these were the estimate numbers. Okay, so these are the reported numbers. So we can see um, oil was actually a lot higher than. I think these were just my forecast. I don't think I got these from anywhere. I just sort of looked at the numbers and thought what looked reasonable, and so I was pretty spot on with the gas. A little bit pessimistic around the oil when I should have probably uh, uh, thought. Obviously, I was sort of below what it turned out to be. Production was lower than I kind of forecast or thought it would be, and obviously revenue is quite a bit lower. Obviously connected into that pretty much. So yeah, a reasonable result, all things considered. And as I say, I mean, when we look at the news update, quite how it's dropped by 3.8, and we'll look at it a little bit more. I obviously haven't written an article about the trading update from 2 days ago, so I'm just kind of talking about it on the fly a little bit. So anyway, the yeah, I suppose the key thing here then, this just strong cash flow, some great assets. They're in the position or they're in the process of acquiring this one, which is a heavy oil asset, which is quite an interesting. So it's a lubrication oil rather than so there's work going on around the Triton area. So there's some drilling here. So there's various different assets. The core ones are this one and this one, the BKR and the Triton, and then there's a couple of sort of outliers that produce sort of smallish amounts that are sort of less material. Okay, so the what else can I sort of perhaps share? Yeah, I mean, obviously, I talk about the acquisitions, and in fact, we see in the article today that there's further acquisitions planned. So let's just drag this article over to here. Sorry, it is this one here. There we go. So I've got too many things open. Yeah, so outlook is promising. The drilling program is expected to boost production. And obviously, when you are announcing additional production of 6,000, well, yes, of course, it's going to boost production. They talk about their commitment last year to shareholder distributions last year, and we expect substantial cash generation in 2025, allowing us to continue delivering. I like those words, continue delivering. So the dividend sounds nailed on. Obviously, nothing's guaranteed, but it sounds positive. The dividend being 23 pence, 23 pence a year, which on a share that you're buying for £1.48. Well, you do the maths, but you're looking at kind of 16-ish%, maybe a touch under 16 at current prices. So really strong return, and yeah. I won't wax too lyrical about that, but you can see it's pretty positive. So yeah, it's halfway through the five. There's a five well drill program. The one that's already operational is ahead of expectations. You know, the the opportunities that they were able to find on mature fields. I think credit where credit's due on that. That they're more than offsetting natural decline. They've got the three remaining wells. They're working on M&A, mergers and acquisitions, liquidity of 442. So we're not talking about a share where you know you're living on the edge of a knife. There's quite a bit of safety built into. And in fact, when I looked at this share last year, it was almost to the point where, like, forget about all of their fixed assets and all of their uh, uh, yeah, sort of non-current assets. I think the cash debtors and cash receivables and stock actually covered all the liabilities. So essentially when you strip out all the liquidity, uh, you know, liquidity in GBP and liquidity in barrels of oil, I guess, that you're essentially getting a business for free. I mean, I think that's pretty cool. Or at least that was the sort of what the numbers showed at the time. Yes. So look, this latest well, the GE05, 9,000 barrels, stable at 6,000. The next one is similarly positive. I guess it's fair to say that obviously this one is only 10%, whereas this one is 100%. I'm just noticing these things as I say, I'm doing this slightly on the fly. There's then the next one, so potentially high impact, like the words potentially high impact. And obviously we'll find out about that one in a couple of months, and then again, this one will conclude begin in April, and it won't go into production until next year. But obviously, we'll know dual results and flow rates once so again in Q2 probably, or maybe Q3. And then they're working on other opportunities. The BKR is the Bruce field, or the BKR field. So they're also looking to add reserves to as well, which is great. And the two compressors, so the thing that held things up and messed up the production really in 2024, is going to be sorted this quarter. So not until by the looks of things, March. So there's still a potentially Q1 of this year could be a little bit ropey, because the one compressor they've got, they've basically got reliability issues. The point being that once they've got two, that they can kind of operate one and kind of repair and do stuff to the other one, and then once they've finalized that, then they've obviously got some redundancy that'll just mean if one goes boom, the other one takes over, and it carries on. So that's all good. That's positive. So yeah, 40,000 barrels of oil, 20,000 oil, 20,000 BOE gas. It's all good. There is going to be some offline time in Q3. Their OPEX again is very aggressive, same as it was in 2024. So sorry, OPEX is sort of same as last year, but CapEx, sorry. I was looking at that number thinking that was a little bit higher than I thought it was going to be. CapEx 220, so it's kind of on the same scale as 2024, when CapEx was 260. So it's well, potentially 10 to 40 million less than 2024. So at that level, with the extra production, with obviously in a sort of generally higher prices, certainly higher gas prices going into sort of January 2025, that well, I mean, who knows whether we might see some drops in price, possibly, but if the Ukraine war ends and all of a sudden we become Russia's friend again, or who knows, there could be reasons to think that gas and power prices drop. But Plenty of reasons to think they won't. So let's see. Let's wait and see on that. So okay, I guess to draw it to a close, then the I suppose the other thing that I've not really talked about, but I thought was also interesting, and I think it was actually mentioned in this RNS, was this: to qualify for the decarbonisation allowance to offset against tax. So even if the decarbonisation allowance isn't sort of valuable from like how many pounds and pence, the fact that you avoid 78% tax, that's pretty cool. That is pretty cool. So that's interesting. Obviously, we don't really have. Well, I haven't done any digging into what this is and what this could mean and how much this could be worth. But sounds interesting. Sounds like something to go and have a little look at. Um, yeah, and connected in with that, I think, again, people politically will have views on the merits and demerits of carbon capture, but the reality is, I mean, regardless of, what you as a voter or you as a rumpher think, the reality is the government are pursuing these carbon capture projects and spending taxpayers' money on pursuing those. 30 billion, if I'm not mistaken, is going into such projects. So, I mean, as an investor, because that's, as I say, I'm not interested in talking about politics, but as an investor, um, these guys have got lots of storage capability and locations, and they're looking to grow and really stick with the North Sea. I talked about how Serica could kind of maybe find a new jurisdiction, go and operate out of Norway or operate out of North Africa or operate out of somewhere else in the world. But that was in one article that I talked about that like get out of the risky jurisdiction of the UK, which is just bonkers to say that. But anyway, but in my last article, in this article, Reeves attacks the North Sea. Uh, the thing that I sort of mused was, well, actually, last man standing could be a genius strategy, because people that are leaving the North Sea, well, you know, if they're looking to sell up their assets, who's going to buy them? Like the North Sea is kind of not on the radar of any Americans. I think the American, all the American oil and gas are just not interested at all because of the political dimension. It's a complete write-off. But at the end of the day, if you can get oil out of the ground profitably, um, that's what matters, you know. So, like the fact that the UK is so unloved is an opportunity for investors. There is that sort of contra point to look at. And could Serica grow itself into becoming the UK's number one? I mean, that's kind of, I listened to their presentation 2 days ago on Investor Meet, and that's kind of their strategy. So the thing that occurred to me that I thought, I wonder if that's what they're going to do, is what they're going to do, at least according to their presentation. So, and it's worth sort of saying, the Finn Bewley field that they're in the process of acquiring um, has something ridiculously low around the amount of CO2 that gets generated or used to generate the fuel, to generate the oil and the gas, out of. So essentially, the project is built around the idea of using renewable energy to pump and to operate the wells and the extraction, and as a result, the CO2 is absolutely tiny. And you can see here, I mean, the CO2 per barrel of oil equivalent is anything up to 97 gram, sorry, 97 kilograms, sorry, per barrel of oil. Now, when you think there's 100 million barrels of oil per day, I mean, if we're chucking off what, 79 kilograms average. I mean, that's just a vast amount of CO2 that gets generated worldwide just to extract oil and gas. Well, actually, this will be gas, thinking about it, because obviously this is LNG import carbon intensity. But yeah, this is carbon intensity of natural gas. So yeah, UK North Sea oil is average 21, and the project that Serica could be involved in is I'm pretty sure it's 1.5. So it's te over 10 times less, 15 times less than the norm for the North Sea. And of course, we are buying our gas from elsewhere now, because we're not producing it domestically because of the 78% tax. But the gas we're buying in is on average 79, and if we're buying it from Peru, it's 97. If we're buying it from the US, it's 78. Because of obviously you're paying all, there's all the emissions from the transportation, and the compression is very energy intensive, and so on. So yeah, whilst I, in a separate breath with diversified, um, I'm involved, I guess, in investing in a company that does do that. There is the contra, that from an energy point of view and from an emissions point of view, um, Serica can tell a good story about how its footprint is far smaller than as I say, the footprints that the government policy is encouraging. The government policy is actually encouraging higher CO2 emissions by punishing domestic producers. But anyway, I think that's probably about as much as I can say around Serica. So I hope that's been a useful um, talk through of this idea, and I'll be covering the remaining Oak Bloke 25 for 25 ideas um, in due course. And thank you very much for watching this one. Um, and cheerio for now. Cheerio.